Hello, I'm here today with Colin English, who's Head of Business Development for the UK for MN Services, one of the brave new investment managers leading in fiduciary management in the UK market. Colin, thanks very much for allowing us to come along and talk to you today.
Yeah, very welcome, Brian. Thank you for inviting me.
It seems a long haul since you opened up, though, in the UK, doesn't it? Are your Dutch masters happy with that? Are they still happy to continue with their commitment to the UK market?
Well, it's only been since the end of March 2009 when the FSA gave us authority to start marketing our activities. So it's only just over 2.25 years. And in pensions terms, I think you'll agree that's relatively short timescale.
Yes, I guess you're right. 2 years isn't a very long time in pensions. For the benefit of trustees who may be forgiven for having so much on their plate these days, it's hard to keep up, could you actually give us the essence of what fiduciary management is all about?
Absolutely. Well, in very simplistic terms, what in essence it does or attempts to do is provide trustees with the ability, together with their existing advisors, to create a more enhanced, a more broader investment strategy, trying to get more return per unit of risk. And that's achieved in a number of ways, primarily through diversification. We can come on to that a bit more later, perhaps. But the key to a fiduciary manager isn't just helping develop a more enhanced strategy. There are many investment consultants that have huge resources that can do just that. The difference between an investment consultant and a fiduciary manager is the fiduciary manager then has the responsibility, the infrastructure and the resources to be able to implement that enhanced investment strategy. So in effect, a trustee board, a corporate sponsor and a trustee board can plug into huge resources that, unless they were a very, very large pension fund like a BT or a USS, they wouldn't have the financial capability of being able to plug into.
Interesting that you brought in investment consultants and then you brought in the word implementation. There's a growing number of our homegrown UK investment consultants have actually introduced some sort of version of fiduciary management or implemented consulting or delegated consulting, what's in a name. Is it because they are scared of your competition, do you think, or is it because they actually understand the UK market better than you do?
I don't think they're scared of us as competition. I do think they're trying to provide a more developed solution for their clients. And whichever competitor you're talking about, or you're referring to, when the investment consultants, global actuarial firms, when their investment divisions are changing their business model to imitate or attempt to imitate what a fiduciary management service provider actually offers to trustees, it's quite flattering. And it's certainly helped develop the appreciation of fiduciary management or one of the other brand names. It's certainly helped develop the appreciation and awareness amongst trustee boards at a much faster pace than we originally anticipated. So I wouldn't say they know the UK market better. They will have solutions that will suit certain segments of the UK market to a better degree. But as far as I'm concerned, ignoring my role at MM for a minute, the fact that an improvement in what was happening before in terms of pension fund investment governance, any improvement is to be welcome, and any support, enhancement that a trustee can get from its service providers has got to be a good thing.
Is it largely a question of education? Do you think that educating trustees to appreciate the added value they can get from your version or one of the other versions that we've just been talking about is the biggest job that you have? Or is it persuading them that they can actually get some financial value out of going down this route?
I'm not sure whether education is the biggest challenge. Education is pretty constant, even when you've decided you're going to go down a fiduciary management route. So typically, after an appointment, the first 12 months, there's a lot of education required before we can actually get to the stage of implementing our recommended new strategy or enhanced strategy.
It's interesting what you say about education. Certainly, to my mind, it's an ongoing thing. There's always something new coming up, and everyone is still learning. But trustees who've built up a good relationship with their investment consultant in a traditional sort of environment, how are they going to feel with this new structure? And indeed, is there a role for the investment consultant? Is their relationship with the client threatened on the basis that suddenly this vast juggernaut has come in with significantly more resources than your average investment consultant?
That's a very good question. To be 100% sure about this, there is a strong role still for an investment consultant. Under our particular business model, the investment consultant can either still be leading the development of the strategy with the trustees, and we could be supporting the development with ideas, with comments about new products, innovations in the market, or indeed we can be leading the strategy and the investment consultant can be playing an overseeing, a checking, a reporting, an interpretation role.
A very big question for me would be, if we have this vast structure, we have the tip of the iceberg is the sort of interface with the trustees, how do you actually convince trustee clients that there is opportunity for a reduction in unnecessary expenditure? Can we promote fiduciary management as a way of controlling costs or making them more efficient, or are we just basically going with the added value of a more carefully resourced strategy?
Well, I feel quite strongly that cost shouldn't be a key consideration for whether or not a trustee board considers fiduciary management, because the benefits and the value that's delivered by a strong fiduciary manager far outweigh the actual pounds cost of employing them.
Okay, well, I can hear my viewers shouting at the screen, he would say that, wouldn't he? But the $64,000 question, if that's the right amount of fees to put into the equation, is why have you set the bar as high as you have? If you are capable of deploying these vast resources to produce efficiencies, why set the bar at £100 million of assets or whatever it is? There's a hell of a lot of SME funds out there with assets of less than 100 million who are in desperate need of some good quality advice and some real support on their infrastructure.
The reason for that is the approach that we take is very, very bespoke. It's not necessarily complex, but it's very bespoke to a particular client's needs, circumstances and requirements. That means there's a cost involved, and that means from a practical perspective, our business model starts to look a little bit expensive compared to alternatives on the market once you're looking at funds below 100 million. That's not to say we couldn't provide services for funds with less than 100 million. It's just that it might not be the best value service option that they've got in the market. And some of our competitors, even though their solutions might not be quite as developed as a full fiduciary management approach, and might be a little bit more off the shelf as opposed to a personalised bespoke solution, it's still a vast improvement on what was happening 3, 4, 5 years ago. And as I mentioned earlier, I believe any improvement is to be applauded. So yeah, there's some good competitors out there with good business models that are geared up to small funds.
Well, thank you, Colin. It's been very interesting talking to you this morning. Thanks for allowing us to come in and do so. I know we've only just scratched the surface on what is a very complex subject, but I'm sure that there will be some comments and feedback that you may or may not want to hear from our community members. Thanks for watching. Goodbye.